Okay, so what we have on store right now is a really exciting topic of taxes. Everybody loves taxes, but right now there is a very keen interest in taxes since we have some major changes to the tax code. So the last week of December, I spent the whole week basically answering questions. What should I do last second? How's this going to impact me? So it was normally going to be kind of a quiet week, a week I do a lot of research and finalize things, think about the next year, became more of a email firestorm, if you will. I was going to use a different word, but that different word has caused some chaos in the media right now, so I won't say that. So basically what we're going to do here is we're going to look at how the tax reform affects everybody. So what I'm looking in this specific webinar are provisions that affect all people. I then break it into some other webinars. We're going to look at the 7 deductions that are going away. So that affects a lot of people, but not quite as many. And then I'm also going to get into small businesses. I'm still myself getting my arms around the small business changes. I mean, they're massive. And not just small business, but business in general. The corporate return is very, very different than what happened on the personal return. So it's really going to have an impact. And trying to figure it out, especially for S Corp and LLCs, is going to be quite a little task. So this is the first part of what we'll see. Is probably going to be a 4-part version of webinars. I'm trying to break it up so you just take in what you need. You don't have to listen to the things about small business if you're not a small business owner. So let's kind of jump right in. And the biggest things we're going to have for everybody is that the rates have changed. So the tax rates have gone down for everyone. A huge change in how they use the standard deduction. So there's going to be a lot more people that are going to do the standard deduction as opposed to itemizing. This, they said, could affect, I've seen everything from 70 to 85% of the people now will only use a standard deduction instead of itemizing. And that's why they said it's going to simplify the tax code. So we'll see if it will or not. Some credit and deduction changes. And then I just have some real quick ideas for future years, maybe how you can find some tax savings going forward. But the big thing here is the new tax rates. So this gives you a little bit of an idea of what the tax rates are going to be and what income levels they're going to hit. And the big thing you need to remember here, at least right now, these are only set for tax years 2018 through 2025. So unless the Congress and President sign permanent cuts into law, tax year 2026, we go all the way back to what the tax rates were in 2017. So, enjoy these while you got them, because who knows if they'll be around forever. But just to give you kind of a side-by-side comparison, what would have been the 2018 rate here under the old law, and now the new rates under the new law. So the big thing is the 15% bracket dropped to 12. So a lot of people, if you're making around 77K as a married couple of taxable income, that's not just total gross income, that's taxable income. Before you were paying 15%, now you're paying 12. So that's a nice little 3% deduction. But where it really starts to hit in is the next bracket up is 22%. And it basically took over the 25% tax bracket, but also a good portion of the 28% bracket. So now a married couple can make $165,000 of taxable income and only pay 22% federal income tax. Whereas before, they would have gotten into the 28% tax bracket. So at least $10,000 of their income based on the prior tax laws would have been taxed at 28%. And then the vast majority from $77,000 to $156,000 would have been taxed at 25%. So that's a considerable savings. And then they also took the 28 and 33% bracket, a portion of the 33% bracket, and turned it into a 24% bracket. So now a couple who makes $237,950 of taxable income will be taxed at a maximum rate of 24% as opposed to 28. But if you bump that up from 237 to 315, you would have been experienced a 33% cut. Now you're only going to get a 24% haircut. So that's pretty sizable. You're talking 9% for people who are making, over $300,000. That's pretty nice. Well, it's pretty nice if you make over $300,000. And then we jump from the 33%. Then we have a 32% bracket from 315K to 400K. And the 33% extends all the way to 425,000. But under the new law, once the 33 breaks, part of it's going to be 32. Part of it's at 24%, part of it's at 32%, and part of the old 33% bracket's at 35%. And then the 35% tax bracket remained exactly the same, but then the 39.6% bracket got broken up. Part of it's at 35%, part of it's at 37%. So isn't this exciting? The bottom line you need to take away is everybody is going to have lower tax rates. So even if you were in the top tax bracket before, you now are in a lower bracket. But probably the biggest thing that's going to affect people is the standard deduction. So they almost doubled the standard deduction. The standard deduction now is kind of a standard deduction / exemptions. So the new tax law gets rid of exemptions completely. And what exemptions were is for everybody that was in your household that you're claiming on your tax return, you got a $4,050 deduction from your income for everybody in that household. So if you have 10 people in your household, you're looking at $40,500 of deductions that you could take from your income. Well, that's gone. Now it's all standard deduction. So what they're saying is this is going to simplify the tax code because a lot of people who were maybe itemizing before but didn't have a lot of itemized deductions are now going to be well within that $24,000 standard deduction. So here we're looking at the itemized deductions, and basically how this has changed is it's been a big change as well. The other thing to remember, again, is these will expire after 2025 unless made permanent by the Congress President. So right now, there is no overall limit on the itemized deductions, but they severely limited what you can take in many of the categories. Now, one of the good things they did is they lowered the medical back down to 7.5% of your adjusted gross income. So the way it was set in 2017 is you take your adjusted gross income and you multiply it by 10%, and you can only deduct the amount above that. Now they've lowered that back down to what the rate used to be a few years back of 7.5%. So for instance, with the old law, if you made $100,000, you can only deduct medical expenses above $10,000. Whereas now with the new law, you can deduct all your medical expenses above $7,500. Mortgage interest had a big impact. You can still do your primary home and a second home. It has to be primary, or it has to be a traditional mortgage. But the limit now is $750,000 as opposed to what it was before of $1 million. Now, I know a lot of people think, oh, that's only for the really wealthy people. But if you live in California or say Seattle, segments of certain states, New York, especially like New York City, Boston, there are a lot of areas where $1 million home isn't really all that great of a property. It's not what you traditionally would think of. I grew up in Flint, Michigan. $1 million home there would just be gargantuan. But $1 million home in San Jose, California, you might be looking at something a little bit nicer than a townhouse. Seriously. So this will have an impact on a lot of people. Now, you are kind of grandfathered in. If you had $1 million debt before 12, 15, 17, you can still deduct all the interest on that $1 million. But going forward, you can only deduct interest on the $750K limit. The other big one is the home equity line of credits. You used to be able to deduct the interest off of HELOCs or any kind of home equity lines. That's gone. And there's no transitional relief. So that means even if you had the equity line open before this tax law passed, it doesn't matter. It's gone. And that's going to affect a lot of people. I've had folks that do remodels, they send their kids to college using it, they buy a new car. There's a lot of things they do, vacations. That interest is no longer deductible. State taxes is probably the biggest area of the itemized deductions that are going to change. So any state and local income taxes are capped at $10,000. The other thing, they won't let you prepay your next year's taxes for this year. So this is huge. The state income taxes, it's not just state income taxes, but it's also property taxes. So that $10,000 limit can get hit awfully quick. Again, this is going to hit people in high tax states that pay a lot of property taxes, California, New York. So they pay a lot just in state income tax, but then they also have higher real estate taxes than most states. So they're going to be capped at $10K. Nothing they can do about it. So this was probably one of the biggest provisions, one of the most controversial, but it did basically get through. At one point, I think they were talking about not having it at all. So they kind of maxed it at $10K. This casualty theft losses are pretty much gone except for federally declared disasters. This doesn't hit a lot of people, but if it does hit you, that means you've suffered a severe financial strain due to a theft, or maybe your pipes burst in your basement and destroyed your basement, things like that. So that tax break's gone. So that was always one of those, if you could take the tax break, you really needed it because you probably had a lot of out-of-pocket expenses. And then also the miscellaneous itemized deductions are gone. Those have always been subject to 2% of your adjusted gross income, but that hits a lot of people. It's not a huge deduction for people, but a lot of folks who pay union dues, who have education for their job, who buy their own uniforms or equipment. It's people who have investment advisors or planners where they're paying fees, and then tax prep fees. So all of those are gone. So that's going to hit a lot of people. Again, not a huge money amount, but pretty consistently you see it for a lot of folks. Some other newsworthy changes, alimony's gone. So a lot of people I know have given their ex-spouse a nice chunk of alimony because they knew it was tax deductible. So now you're going to have to look for other ways because it's no longer deductible. On the flip side, I think people who are going to receive alimony will want to get more of it because it's not going to be taxable. So that's a biggie. The moving deduction's gone. So if you're trying to move more than 50 miles for a job, now it's on you. You have to do it. And the other thing is they took it away where the employer pays it. So even if you try to get your employer to pay for your move, that's no longer exempt from taxes. It's included as taxable income. The only caveat there is military folks. They still get to deduct all moving expenses from their pay. So I guess they would be able to convince military people to move every 2 years if they were going to be taxed on the cost of the move. Another one that's pretty esoteric is recharacterization of Roth IRAs. What happens is if you convert from a traditional IRA to a Roth, or if you move a 401k to a Roth, you pay taxes on the amount that you convert. Well, you had a little bit of a natural hedge in the tax law because if you convert to a Roth and the markets tank and all of a sudden the Roth loses value, the government used to let you recharacterize that Roth back to a traditional and then do the conversion again. So if the markets dropped, you could recharacterize and then convert again, just so you don't pay taxes on the amount of money that your Roth lost as soon as you did the conversion. So again, this doesn't hit a lot of people, but if you do a Roth conversion and the market tanks, you're probably going to be a little upset that this is gone. They did double the estate and gift tax exemption up to $10 million per person. So I guess that's good. You can pass along more money to your heirs. I don't want to get into politics of the whole thing, but I guess I think it's good. But what I think is bad about this, and it doesn't have to do with taxes, but I think a lot of people stopped doing estate planning when they realized that they were no longer going to be subjected to any kind of estate tax or gift tax. They just figured, well, you know what, it's way above what my wealth is, so I don't need to do it. And that's just not the lesson I hope people take away from all of this. I hope what people will do is they'll continue to do the estate planning, because it's extremely important to do that. Mostly, what's going to happen to you when you die, what's going to happen to you if you become incapacitated. All of those things are critical parts of your financial plan, and obviously estate plan. So I do hope you'll still get a will in place, your medical directives, and a trust if you need it. Don't let that $10 million exemption sway you from not doing estate planning. So again, we mentioned exemptions are gone. Now this is probably going to hurt families that claim their parents or other non-children. So if you have a boyfriend or girlfriend living in your house and they have kids and you're claiming them because you're providing support, that's gone. Those exemptions are gone. It'll also hurt people who have quite a few children that are older than 17, but they're still claiming them. So if you have 3 or 4 kids in college, you don't get a child tax credit for them, but the exemption for them is gone. So that's going to have an impact on you. But for those parents who have the kids that are under 17 and still live in the house, you get a child tax credit that was doubled. So it went from $1,000 to $2,000. The other big thing with this is they increased the phase out. The child tax credit used to go away at $75,000 for single individuals and $110K for married folks. Now it's gone up to $200K, $400K respectively. So people who are making higher incomes can now take the full $2,000 child tax credit. So that's going to be huge. I've seen lots of clients that get phased out of the child tax credit quickly. Well, now they're going to be open up and have a nice little tax break there. So here's some examples, just trying to give you an idea of a couple, a family of 4 where they're making about $100,000 a year. They're paying state taxes of $8K with about $10,000 in of mortgage interest and $500 charitable. And then we're going to look at a family of 4 with a little bit of higher income, the $250,000 limit, and really only about, I think, less than 10% of America would hit that $250K limit. But it's just to give you an idea of how's it impacting kind of more of the middle America and then kind of upper middle class. So you can see from this, basically under the new law, your taxable income is going to be substantially higher because of the standard deduction and the loss of the exemptions. But you end up not paying as much in tax because of the child tax credits in many cases. The lower rates help, and then the child tax credit is enormously helpful. So for the first example, taxable income $64,400 under the current law, and then the new law, the taxable income of the $100K would be $76,000. So you end up paying a little bit more in tax, just gross, but then when you factor in the child tax credits, your total net tax, you're going to save almost $2,000. And even if the kids are 17 or older, so they're in college, and you lose that child tax credit, you're still looking at a situation where you're going to be a little bit to the plus of almost $1,000. Now, the family making more than $250K, a little bit different story here. So the nice thing is they are going to get $4,000 child tax credit, even at the $250K level, whereas before they wouldn't have. And that's going to be huge because, as you see, they have a lot more taxable income, which produces a higher tax at $35,679 compared to $28,908. But that $4,000 is going to deduct from it. The other thing is the AMT, the alternative minimum tax, has been radically modified as well. So under the old law, that family of 4 making $250K would face almost $3,400 of AMT tax. Well, now that's gone. The level is higher, so that it doesn't affect them. So the total tax liability for this couple is actually going to go down about $601 based on the new tax law. But if your children are over 17 and you lose that $4,000 tax credit, child tax credit, now all of a sudden you're actually going to be paying almost $2,400 more. So, I don't want to get into the politics of it, but it looks like, some higher income folks could end up paying a little bit more than they were before. In some cases, it really all depends on the individual. But I do think for more of the middle income folks, they are going to see a tax break of some sort. So what could you do? What I'd mentioned when we talked about the itemized is there's going to be a lot of people who might be close to itemizing, but now with the higher standard deduction, it makes more sense to do the standard deduction. So I think what we're going to start to see in tax planning is more bunching of deductions. And bunching just means you double up in one year and then the next year you don't do any of it. So for instance, if you're giving $3,000 a year to charity, what you might do is give $6,000 this year and then nothing the next year. You could also prepay a couple mortgage payments at the end of the year just to get that interest credited to the current year rather than the next year. Also bunching medical expenses. So if you know you're going to have a surgery one year or a lot of dental work or something like that, or if you have an unexpected medical expense, you went in the hospital, well, that could be the good year to go get your knees done, get your shoulder done, all that other stuff. You really try to get as much medical into a single year as you possibly can. So this just gives you a little bit of an idea. Let's say this year we want to see how things shake out. So you basically just live your life and you find out you had $3,500 in medical. You get capped at that $10,000 for the state and local income taxes. You get $6,000 of mortgage interest, and you give $4,000 to charity. So your total itemized would be $23,500. So you're still better off with the standard deduction of $24,000. So you're like, well, that stinks. I was so close to being able to itemize. What should I do? Well, this is where the bunching comes into place. So the next year for medical, you try to do a lot more of the things you've been kind of holding off on. Knee replacements, hip replacements, all little eye things, dental work. So you crank that up, you double it to $7,000. You're still going to be capped at $10,000 for the state and local income tax. For the mortgage, you do one extra payment at the end of the year, so that gets you another $500 of mortgage interest, so you're at $6,500. And then for the charity, you do $4,000 usually. This year, you're going to do $8,000. So now all of a sudden, you have $31,500 of itemized deductions, well above the $24,000 standard. So you'll get to deduct $7,500 more than what you would under just the standard deduction. And of course, because you front run in some of these and you bunched it, so year 3, maybe you're not going to have as much of the deductions. So you don't have any charity, mortgage is a little bit lower, maybe you still have some medical, but you end up with maybe $17,000. So you take the standard deduction of $24,000. So again, what I'm going to be doing is a series of webinars just talking about all the various aspects of the new tax reform law. But you can also just make sure you get all of our insights on this by going to our website, Picket Fence Financial, or savingyouFromWallStreet.com. We'll make sure we keep you abreast of everything. We do all kinds of interviews and webinars and podcasts and articles, all that good stuff. Try to have some information that you can really use. Of course, we have a Facebook page, Picket Fence Financial. And if you don't mind looking at my ugly mug, you could go to my YouTube channel, Kirk Kinder. There I've got all kinds of videos and webinars that you could check out. And of course, we always finish off with a little disclaimer where the lawyer is saying hello to you. You can pause it here if you wanted to read all that exciting information. But I do appreciate you listening in. And if you have any questions, please let me know. I'll be happy to help in any way I can. Thank you.